Awesome. Just starting the webinar now. We're going to let all of the attendees roll on in and give us a few minutes to get started before we jump on in. Common questions we get that I will answer right off the bat and make sure to reiterate this. We do record this webinar, so we will send a recap out to everyone. We will also include a written recap, as well as highlight any of the content discussed today. So resources, links, articles, investor lists, we're gonna link that all in the write-up. And then if anyone has questions throughout this webinar, just hit the little Q&A. Our team is in the background monitoring all questions. So we'll get to those at the end. And if it makes sense, I'll jump in with Lolita and answer the question off the bat. Yeah, so feel free to jump in and ask questions. And I think we're ready to get started here. So really today it's all about first-time founders, guide to fundraising. And clearly we're in an interesting time, so I'm sure we'll touch on that with Lolita, but really excited to introduce everyone to Lolita. She is currently a venture partner at NextGen Ventures. You can find her on Twitter at Lolita Taub. And I believe, Lolita, you're also moving soon, is that correct?
I am. I have my moving box, as you can see. So we've been working remote and out of Baltimore, but we have a home in San Diego. So we're gonna go to our home there and be closer to family. So exciting times, but it's kind of stressful because we need to do this without being exposed to COVID. So we'll see.
Yeah. So is that going? That's a long drive. Is that a drive that's happening?
So interestingly enough, my husband and I talked about it, and we initially thought that would be the least exposure, but based on the fact that you have to drive, stay at hotels, it seemed to be the most exposure. So we just decided to do a traditional move, get some movers, and just fly out. So we'll be in San Diego on the 17th.
Oh, that's awesome.
Yeah.
Well, really excited to have you on today. Thank you so much for joining us. For those of you that do not know me, my name is Mike Pruce. I am the co-founder and the CEO of Visible.vc. We help companies build relationships with their investors, provide really beautiful investor updates, and coming soon, a fundraising CRM for you to help manage all of those different relationships. So today, really, like I mentioned, for those that are just trickling on in, submit all your questions through Zoom chat. We'll get them towards the end or interject if it makes sense. We're recording this and we'll send out the recap this week. So get those questions all the time. Absolutely, we'll send this out for those that have to jump out early or can't make it because of time zone issues. We'll send this all out. Today, we're going to talk about COVID impacting on the fundraising environment. How do you split time, especially right now, between fundraising and cash efficiency? Those two things are kind of mutually exclusive in some respects. We'll also touch on what are the sources of capital are available outside of venture capital, and then getting into some more tactical fundraising strategies. Pre-fundraising research. How do you think about building relationships early on? How do you track and manage that fundraise? And Lolita has a lot of expertise around underrepresented founders and people that have been underestimated in general. So we'll make sure to give that a great talk track at the end as well. But just to get started, I can't tell if people are sick of talking about this or not, Lolita, but let's at least mention it. There's been a ton of work done and great resources around, who is saying, hey, yeah, we're open for investing, and the reality of, like, are they actually writing term sheets? And so I would love to just get your kind of quick take on COVID, what you're seeing on the front lines as an investor and across your portfolio. Are people writing checks that say they're writing checks, or is that just window dressing?
Yeah. I mean, I think the answer is mixed, right? But first of all, thank you so much for hosting me. And I'm so excited to have this fireside chat. Thank you everyone for joining. I've had many first-time founders reach out with questions specifically about fundraising amid COVID. So I do think it's a really great topic to talk about in terms of fundraising is tough, but within COVID, there's all these different implications that I do think are really interesting and important for founders to understand before you do go out. So you're making the most of of the work and activities that you're doing, and basically just being armed with all the knowledge that you need to be successful as you can be in this state. So some investors are saying business as usual, but it is not business as usual. In fact, most funds are, I did a poll actually on Twitter, and less than 30% of the funds said that they're not looking at new deals. So basically 70% of funds are either looking at only existing companies, portfolio companies, or they're maybe dabbling, but they're really focusing on supporting their existing portfolio companies. And for those of you who may not know what portfolio companies, it just means the companies that investors have already invested in. And this is in particular has to do with venture capitalists. So what we're seeing is that a majority of the time that investors are spending, they're spending with existing investment companies that they have in their portfolio, and or they may be putting more money into companies, but when they say they're active, it may mean yes, they are, but only in their existing companies. So I think this is really an important differentiator. So know that if you have existing relationships with investors, those are probably your best bet, but understand that a lot of them are spending their time in their existing portfolio. And I actually did another poll on Twitter where I asked about angels that are investors and operators, because I'm also an investor and an operator at the same time. And what's really interesting is that investors and operators together in my poll said that 25% or less of their time is being spent on investing activities. And so you see an overall decrease of the angels that are investing, and then a decrease of funds that are spending time on net new deals. And I think it's super important for you to keep that in mind as you fundraise, as well as a couple of other things. One is because of the demand and supply model, you're going to have to accept the fact that valuations are probably going to drop. And so I think we're going to see a huge decline in the valuations of when you do go out and pitch and say, hey, this is the value of my company. And investors saying, yeah, well, maybe pre-COVID, but now it's a different world. And then the last thing I would say is that in the fundraising environment, what's also changed is that now instead of pitching in person, it's becoming more of a normal thing to pitch online and have pitching videos. In fact, I'm a Techstars Anywhere mentor, and we just had our virtual pitch session or demo day, and they were all videos. So it was the founder and then their deck in one visual, and you could hear them pitch. And so that's something that's also really new, and because of COVID.
Yeah, it's crazy how the world is just completely shifted from what went to like traditionally very in-person, relationship driven, in the same room, to everything's remote, not first, but remote only. I was actually just talking to an investor though, and we were talking about how, the world was trending in this remote first or friendly way. This is kind of a function of that. And he was telling me that years ago, he did a deal where there was invest the founder without ever meeting them. Never actually met that founder throughout the time of the investment, and was a 6x exit. So it's not like people aren't funding deals that are being remote or having great outcomes. So I think it's just a different muscle that everyone's gonna have to build with remote. I think the one with Zoom is it's hard to grab that interpersonal kind of reaction of like how sensing someone is. But yeah, so the short there is, it's impacting everything from amount of capital available to terms and everything in between. It's hard, but not impossible. And I think that's a good segue into something that I'm pretty passionate about as well. And Lolita, I think you had a great post on this, which is alternatives to venture capital. And I ripped out a couple of the ones from your blog post here, and we'll make sure to send these links out to everyone right now, as well as in the post write-up of some different alternatives that we've written about at Visible, Lolita's written about in Medium. And just kind of quickly covering these, and maybe we can hit on pros and cons of each of these. But at its top, you have non-dilutive, which is factoring and revenue-based financing. This is becoming even more and more popular, right? There's more data available, systems available, credit card processing is online, so you're able to write loans almost instantaneously with factoring and revenue financing. Then you got friends and family. We touch on that with angels a little bit. Crowdfunding, whether that's through tools like Republic or Net Capital that are providing a platform to raise equity for your company, or there's, Indiegogo, Kickstarter, where you're doing some reward or incentive-based funding as well. And then there's this idea of like bootstrap venture capital, which is fairly new. You have Indie VC, who says they invest in real businesses, which I think is a great little tagline. Earnest Capital is a great partner of ours and customer as well, right? They are providing some level of fund where, you're going to build this, kind of measured growth business, but you just need a little bit of capital to get started or maybe make a key hire. So Lolita, maybe let's just start with some of these different alternatives available. What are your thoughts on, let's start with revenue and revenue financing and revenue-based financing, and maybe some pros and cons that you see there.
Yeah, sure. And even before that, actually, I think this is something that is helpful to level set for folks that are on the phone. VC is not for everybody, and to understand whether you are VC fundable or not, I think sometimes it's very difficult to know. And so I have a couple of tweets out and that talk about what is considered VC fundable or not. And by no means does a non-VC fundable startup mean that it's less than. There's just that some businesses are more built for the kind of aggressive growth that VCs want to see in their companies versus not. And so I just like to, before we jump into alternatives, to point out some things that I think can be very valuable to our listeners. And that is, so a VC fundable company, you usually see that there's a really large total addressable market, usually in the billions. So if there's a huge market, that usually means that there's a big opportunity for startups to pivot. And so they like to see that. VC fundable companies are also very scalable. So it means that it's easy to scale, less manual and more automatic, with expected annual recurring revenue that could go up to 100 million and above, and wanting to reach that $1 billion valuation, et cetera. And this is the traditional set, really, of some of the characteristics for a VC fundable business. The one thing also that I think is really important to think about here is that for VC fundable startups, you also want to, if you want to someday sell your business, then you're likely to be more VC fundable than if you don't, because VCs do expect you to exit your business at some point in time. And then alternatively, if you want to keep a small business, a small team, maybe your business is a bit more manual, then and your revenues maybe cap out at 100 million or below, and you want to keep your business, you don't want to sell it, that's probably, VC money will probably not be the right fit for you. And so that's where you start looking at a lot more of these alternatives of family, friends, personal debt, and really actually looking at revenue, your customers, as a way. I think this is the one bullet point here that I was thinking about, Matt, that is missing, which is just customers is an alternative to venture capital and any of these. And the pros of that is that you don't give away equity and you keep growing. And so you have more control of your future, and you keep that equity in your company. So that would be, like, far off my number one recommendation, is if you can use revenue. And this is down the track of Indie VC, right? Revenue actually does help you grow. And so I would say that's probably the best recommendation, and just bootstrapping in general. Long preamble, but I think it'll be helpful for our listeners.
For sure. Just since it was recent with customers, we Visible have been using Pipe as of, I think, March, and it's been a total game changer for us in our business, where for those that are unaware, Pipe is a tool that allows you to connect to your billing system, so Stripe or Curly, ChargeBee, whatever you're using, and it'll look at all of your recurring revenue invoices from customers that are paying you on a recurring basis, and then they'll actually pay you out on that future cash flow from your month-to-month paying customers. It's called factoring. And it's beautiful because it basically lets you to pull forward future cash flow. They take a small percentage, and it lets you kind of invest in growth, or maybe a key hire you didn't make, or just putting cash onto the balance sheet. So we've been a big fan of that. I know Clearbank's very popular as well, especially if you are more of an e-commerce type play, where you have Facebook, Twitter, Instagram that are driving revenue for you, and you have some sort of inventory Clearbank would take a look at all of that data you have, and within minutes, hours, maybe days, depending on how big the investment is, they'll provide you a line of credit and capital right into your business to help you grow. So I think that's spot on. And then Lolita, going back to different types of capital and bootstrapping, I think that's one thing that we see quite a bit, and I ask founders is, why are you raising capital? Why do you need to raise venture capital? And a lot of times the answer is, I need to be able to have some sort of income coming in for me and my family, and just to get this thing started and off the ground. But maybe it is kind of that quote unquote bootstrap or lifestyle business, and that's not a bad thing at all. But maybe it's not venture capital route you need to go. It's a different route, and I think that's an important distinction. Is why do you want this capital? Anything else you wanted to touch on here? I guess with friends and family, this is one that, and I guess related to angels, that's coming up quite a bit in our community.
Mm-hmm.
People are going this route and just pulling together some checks to get started. One of the common terms or common questions we get is like, how should I think about valuation for my company or this business, right? It's just getting off the ground. I'm scraping together 25K checks from angels or friends and family. What is a fair valuation? How do you think about valuation early on if you go the angel route where maybe someone's not dictating terms and you're trying to simultaneously educate family and friends about your business and a valuation?
Yeah, that's a really great question. I actually have a post on it. I'll share it with you so you can, maybe we can add it to the follow-up.
Yes.
First of all, family, friends, angels are such a great idea because, they're a lot friendlier than VCs because they're basically using their own money. And so the pros of it is you can get it quicker and there's probably less due diligence. The cons of it is that they may or may not be as sophisticated, and the spread of there's a spectrum. So I'm not saying all family and friends and angels do not know. There's a spectrum of them, and I think that you need to be really cognizant when you take money from family or friends or angels, what their level of education and sophistication is in investing, because they might have expectations that are not matched with reality. And so, for example, I've heard stories where family friends believe that they would get rich off of investing, and then they end up losing all their money. And so it's really important for founders who do raise from friends, families, and angels to be considerate of the situation of the investors that are friends, families, and angels, because sometimes it may be that someone has saved up and they are an accredited investor, but this is their life savings. And just being a little bit responsible and thinking through about that, that's one thing. The other thing is that if you get an unsophisticated angel or friend, family member to invest, and they might want to get really into the business when they wrote a really small check, and then they become actually a burden, because you're just like, let me just work on the company, and they, that could be also hindering. So I'd say just setting expectations are really, really, really very important. In terms of valuation, it's a question that I've gotten so much that I wrote a post about it. And there's really no one way of doing it. There's a financial way of doing it where there's particular, a mathematical equation where you just plug it in and here's what you get. But a lot of the time, oftentimes what happens is that valuation is contingent on peers in your market. So if you look at companies that are within your stage and in your industry and your niche, you have a relative understanding of how much other companies that are your peers raised and under what valuation. Now, currently, it's a bit of a tricky thing because, again, the market has shifted and is shifting, and there's so much ambiguity in the market. But what I can tell you is this: you will have to expect that valuations are going to be rebutted and negotiated down.
We call the unsophisticated, burdensome investor Dr. Dan, the dentist, internally here at Visible. You've taken money from, Uncle Dan, who's a dentist and really excited, but then calls you every week to understand what's going on in the company, and probably is more burdensome than not. What, you have an opportunity. Let's say you have an opportunity to take money from Dr. Dan, the dentist, or no money at all. Dr. Dan's really burdensome, or I gotta scrap and fight and claw to bootstrap. Which do you take, Lolita?
I mean, here's wherein lies the challenge, right? So some traditional VCs would be like, just do bootstrapped.
Yeah.
But being a woman of color and serving the community of underestimated founders primarily, and of course I support all of you guys. I'm such a big fan of founders. But being in the space that I'm in as a woman of color, you just have to hustle and do what you need to do for your business.
Yeah.
So while there are these pros, cons, and whatnot, and best practices, and here's what you should do and shouldn't do, honestly, it boils down to what are your options? What do you need to do? And for example, I'll tell you, if you need to take from, this dentist that we're talking about and or like closing your business, you may just want to take from this person.
Yep.
With the understanding that you're going to have a bit of a headache, but you have to outweigh your pros and cons based on your particular situation. The other thing I would say is it's been frowned upon in VC for founders to have jobs, to have side hustles. But the truth is that if that's what you got to do, that's what you got to do. And if investors will not invest in you because you're a hustler and you are doing what you need to do to survive and keep your business and grow your business, then they're lost, because you just do you and take care of what you need to take care of for yourself, your family, and your business.
I came across an accelerator yesterday called Venture Out, I believe. It's relatively new here in Seattle. They are doing a night and weekend accelerator. So for founders that are working at a big company and can't leave and need to do a side hustle, it's kind of like getting an MBA at night, right? It's a way for you to educate yourself and get ready without having to leave that full-time job. We had one related question maybe on this slide, and we can move on. What are your thoughts on some of these crowdfunding platforms? Specifically seed invest was mentioned, but I think you could probably apply that to Republic, Net Capital, any of the crowdfunding type platforms that are giving you some sort of equity, getting capital from a lot of folks. Like, what are your thoughts on some of these different platforms?
You do what you need to do. I'm going to reiterate, whatever you need to do, you've got to do it. I have friends at Republic, at Net Capital, Seed Invest actually as well. And I'll tell you that I've worked with portfolio companies from Backstage, for example, and just other startups in general, other founders who are saying, hey, I need capital and I'm having a really hard time because, just the way the old tropes of VC, how can I raise capital? I'm like, well, let's explore all the different avenues that you have that are available to you. And crowdfunding is some folks don't like. If you look at traditional people, they'll say, don't do it. It's a waste of time. I'll just tell you, if you need to do it, do it. I will say that there's a couple of things to consider with crowdfunding. You do have to put all of your financial information, all of these things that you would usually keep private, out into the web as part of the Jobs Act. There's these requirements for legal reasons and for protection of many people, really, to put out all your information. So that's one thing that you need to consider. The other thing is that it does take time and effort to go through the process of legally putting together a crowdfunding campaign. So that it is work. And you've got to think about it like two things. It is absolutely fundraising, but it is also a huge marketing campaign. So you have to have the time and effort to dedicate to drive a successful crowdfunding campaign. And sometimes people think, oh, well, I'll just do this and then it'll do it. But it's actually something where you have to drive traffic to. So you might have a page, you're doing crowdfunding, but you're literally driving customers, if you will, right? Investor customers into your page and get them to invest. And then other things to consider are that these platforms will take a percentage or some sort of fee. But oftentimes that fee is, it makes up even more time so with the fundraise. Not all companies are accepted to all platforms. I know Republic has like a bit rigorous process and they're looking at, hey, we only want to put out companies that we think are going to do well, and it makes sense as a business model. But there's many companies that are crowdfunding, so it's really important to put that effort and time and investment into the campaign of crowdfunding if you're going to do it. And then one other thing I would say, because I did spend some time building these kinds of plans for founders in the past, and that is, I think it's super important to consider that because it's a visual thing, it's a visual page you're going to, a lot of consumer goods end up doing more. I would say they tend to do a little bit better than, say, something that's very abstract or B2B, something like that, because it's more like, your fans like it. And so that's something to consider. Another thing is that it's, I think, a really great way of showing traction. So if you haven't been able to sell, or you have, but you need it and you want to raise VC, and the VC saying you're too early and where's your traction, this is a great mechanism to say, look, I was able to raise, these many people are willing to support my product, my service. And so it acts like a mechanism. So when VCs or other investors are asking you, what's your traction? You can say, I'm early, but look at all of this. Like, I've attracted all these people that are validating the fact that I'm solving a problem with my company and that it needs to exist.
Yeah, that's spot on. I think with any of these paths, right, there's no silver bullet, and certainly no, if you build it, they will come. So each of these are going to take time, and ultimately, doing what's best for your business. I think related to time and marketing and all this is a good segue just to touch on this a little bit around, especially with COVID, fundraising versus cash, efficiency. Where do you spend your time as a founder? How do you balance this? You have investors saying, cut all these costs and get to profitability, but we're also investing in deals, and that's kind of conflicting. So, like, what are your thoughts on, like, where should I be spending my time right now as a founder? I'm sure it's case by case, but do you think, the adage of profitability is maybe a good thing now? Like, what are your thoughts on fundraising versus cash?
I think someone made a sarcastic, retweeted a post that I had on profitability being a good goal to have as a company, and they were sarcastic, and they said something like, "Oh, I'm glad this is a new focus area." And he said, and then he messaged me and he's like, "I'm so sorry. I think it's so obvious." And I responded to him, "No, it's not. Profitability is the goal of a business. Revenue, return, after revenue, it's profit, and then, returns." And so, but I understand it could be so confusing, right? Because you see all these, you see WeWork, right? And you're just like, well, how did they get to where they got? And they were, hemorrhaging money, and they weren't really making money, but then they are worth how much? And it confuses things. But I think because of everything that's happened, people are level setting a little bit more, coming down to the ground and saying, actually, profitable businesses are good. And yes, revenue is good. And I think Bryce from Indie VC also tweeted out something around, I think this is the best time for Indie because everyone is now saying revenue is a good thing to have. And so in terms of balancing fundraising versus cash efficiency, I'll go back to what I said, bootstrapping, focusing on producing revenue. If that is an option, obviously it really does depend, like Mike said. But if you can, I would put my efforts there. Also, because with fundraising, as we talked about, if you don't have existing relationships and you weren't in talks already, it's really tough to fundraise right now because of the ambiguity in the market. And so what my biggest recommendation, if I was going to make a blanket recommendation, would be focus more on the revenue, and then cash efficiency, and then fundraising, if you have the luxury to do that. It is a luxury. And when we talk about cash efficiency, I do think that it is important to, nobody likes it, but we have to get super scrappy, cut costs that we need to survive and extend runway for companies. And then if you need to, lay people off, because it is a difficult decision to make, but it's between holding people into your business and then having to shut down completely, versus maybe you can extend it through this, make it through, and then hopefully be able to rehire people, but not put yourselves all at risk of going bankrupt and just, ending your business. So it's all about thinking about, how do you extend the life of your company at this time? How can we produce more revenue? Profit is the ideal, right? But it depends on where you're at. Those are the thoughts that I would.
Yeah, that's spot on. It's unfortunately like the saying, you cut off the arm to save the body, right? And it's hard right now. And I know a lot of founders that have had to go through that process, and it's painful, but it's one ultimately that extends your runway. Companies only fail when the founder gives up, and usually the founder gives up when they're out of cash, typically. And so I think that's great. Well, one of the questions maybe we can just retouch on that has come in a couple of times, and maybe, I know we talked about this early on, and I think it's good to touch on this slide. So are you finding that friends and family angels are open to business at the moment, or are they worried due to what's happening with COVID? I think the short answer is a lot of that's not available right now. At least there's certainly a big decrease in that activity. But Lolita, anything else you want to add there to that question? And we touched on it earlier in the chat.
Sure. I definitely think people are open for business. And I do think that but it's less. I would say from my perception, it's less so, or smaller checks, right? So think about it in different dimensions, and it's a spectrum. So if anyone tells you I know exactly what's going on in the market and I can tell you clearly what's happening, they're lying. But from my perception, from what I'm seeing, to me, and talking to my friends and other funds and other investors, what I'm seeing is that angels, if they are still investing, they may be investing, doing their due diligence a little bit slower, deeper, or maybe writing smaller checks, or maybe just pausing altogether. I have had a couple of friends who said, I don't know what's going to happen with the market, so I'm just going to pause for now. And so it's kind of across the map. And so it's really important when you do meet with an angel or a VC, even a VC, to ask them, literally ask them. So, and you don't take my word for it. You ask them, like, are you active? And if it's either an angel or a VC, when was your last investment? Or how many investments have you made? And what's your average check size? So that you can assess whether you're spending your time wisely or you need to just move on, because sometimes people don't want to say this information, but if you ask them, hopefully they would answer well. And on that note, also one other thing to note is that VCs, especially emerging funds and smaller funds, have raised money from wealthy individuals or family offices whose money they don't necessarily have. So when a fund closes a fund, they basically have people and organizations, institutions that have committed to giving amounts of money to invest, but they do it through capital calls. So basically an investor will be like, okay, now I'm gonna do a capital call and everyone give me this amount of money so I can make investments. Well, what we're also seeing in the market, what I've been reading a lot about as well, is that LPs, which are the investors to funds, are pushing back at times, not all of them, but you see, so what I'm trying to say here is that it's complicated. Ask the question, are you investing? Are you active? If so, what does that look like? And what's the timeline? So that you make sure you're not wasting your time. But I will say 100%, there are funds and there are a bunch of angels that are still investing. Yeah,
that's great. I think that's a perfect segue into pre-fundraising research and some of the things you mentioned. So let me move some Zoom elements out of the way for myself here. I'm a founder thinking about a fundraise, whether this is pre, post, or during COVID. I'd love to hear your thoughts and strategies around fundraising research, how to find the right investors for your business. How do you go about building a relationship, right? If I want Lolita to invest in my company, how do I make that happen, right? I think that's what a lot of people I'm seeing here, people post saying, hey, I'm raising money. How do I, get in front of Lolita and get you to invest in my company?
Yeah, well, before you get to, I want to reach out and pitch Lolita. I would recommend a few things, because I might not be the right person and you might waste your time approaching me. So a few things that I always recommend founders to do is to do their homework and identify, and this is in particular with VCs, do your homework and identify what VC funds have a thesis that's aligned with your company, with the industry that you're operating in, and also the stage of your company. So you have a variety of fund size, focuses, industries, and every single fund has a different way of looking at their thesis. It may be based on gender, it may be based on industry, it may be based on many things. Oftentimes though, many of these will have like, here's the stage that I invest in, as well as a check size range. And these things are really important because they need to match up with your startup, where you are, who you are, and how much you're raising. So first is identifying those. And one platform I often recommend you check out is NFX. Signal.nfx.com. They have a great database where you can kind of drag down and select your industry and size, check size, things like that. And then you can come up with a list. But otherwise, you can use AngelList or Crunchbase to do some of this homework. And after you identify the thesis aligned fund, then I usually recommend to go a little bit deeper and see within those funds what investors are going to be the most aligned with your company. And what I mean by that is who would be the most helpful investor in helping you with where you are with your startup. So when you do reach out to them, you can reach out and build a relationship by asking them really specific questions that you need answered to continue growing your business and reach that next milestone, and at the same time build a relationship. So ask a specific question about the specific thing that you're having an issue with. And what's great about that is that it doesn't put this like weird invest in me or let me pitch you kind of mentality. It's like, hey, I have a question and I know you're really smart or have a network or can help me get through this. And that's how, what I would say is super valuable, and I highly recommend. And then the rest of it is just, share, I love how you mentioned, Mike, share milestones. I would do this through email updates.
Yep.
So important.
Yeah, I think all of that is great advice. The one thing we preach at Visible is no one agrees to get married on the first interaction or the first date, right? Unless it's a super big edge case. But for the most part, building a relationship with an investor is it's a process. It takes time to establish that relationship. And I think the asks need to be small to start. And I think that is a perfect lens that you mentioned, Lolita, is, hey, I'm thinking about, I have this problem, or I'm thinking about this opportunity, and just building a relationship with that investor, because there's the old kind of adage of investors invest in lines and not dots, right? And so each of your interactions with them is a dot or a point in time, and your job as a founder or CEO is to draw a line between those dots and show the trend and momentum of your business. That's where milestones really kick in as well. Just
I love that.
providing someone,
I'm gonna have to steal that from you, Mike. The investors.
I wish I made that up.
Who made? I mean, that's brilliant. I hadn't heard it, but it does make a lot of sense.
Yeah, it's somewhere online. I wish it was my own. There's a really cool animated GIF of it, of like the dots, or maybe we made the GIF. But I wish I say I was the inventor of that. And with milestones in particular, this is something really big that we've dug a lot into recently around just update, whether those are to your current investors or potential ones, but just staying top of mind with your investors or potential investors is such a need and necessity, right? Think about how much deal flow I'm getting as an investor, how I'm supporting my portfolio companies. If I'm a venture investor, I have LPs dealing with, and my own potential LPs and current LPs, and supporting my portfolio companies. And so you as a founder, think of it just like go to marketing. Like if you're really great at marketing, you have an amazing nurture cadence that you're running all of your leads through. It's the same thing with fundraising, and what you're selling is equity in your company, not your product or service. But and it's just an easy way to drip. Hey, here's what we're working on. Here's what we're doing. Here are the wins we had. Here's our challenges. And so those are super important, and especially early on, it just helps you kind of show you have a bias for action and are doing something. It's really bad practice to say like, hey, here's what we're working on, and then like a year later be like, we need money. So like, again, it's all about connecting the dots and drawing a trend.
And doing it in a recurring basis. I mean, I'm tracking. So for some of the investments that I'm considering, sometimes I tell them, hey, I want you to reach this milestone. Or what's the next milestone you want to reach? And in fact, I like when I talk to founders and I want to ask them, where do you think you're going to be in the next month or so? And then they tell me specific metrics, and I like them to identify these metrics, and they tell me that I'm going to be there. And then I say, okay, send me put me on your email update list, and let's keep track of it. And I love seeing when founders show the results that they promised when they talk to me, and or seeing that progress. And so to the point of, you know, these dots and connecting it into a line, it's exactly that, because you're building a relationship and you're proving that what you're saying is what you're doing. And that is really important, because investing from an investor startup founder relationship, it's like a marriage. And they actually, on average, investor startup relationships on average last longer than marriages do. So it is, it's true. The average marriage is 7 years, I believe, in the US. And so because the marriage is so long, right? But VC startup founder relationships are probably longer. That's why there's so much due diligence that needs to happen. And that's the other thing, by the way, that for pre-fundraising research, I would say, is outside of, you know, doing your targeted research, being able to be really sharp. So when you do get that connection with an investor, to have a pitch deck with the essentials, you know, market, problem, solution, differentiators, traction, so on. It's really important to also have a data room that starts to have all these documents that investors want to look at. So when they say, okay, I'll take a look, they'll ask you for a data room link, which could be a Google folder. And then you can now easily share it. And then you're off to the races, and you can continue in parallel to sell, like Mike is saying, to other investors, your equity.
Y Combinator has a phenomenal post. We'll make sure to put this in the write-up. And this one's for Series A, but I think it applies no what of, like, how do I think about releasing information in my company? What is appropriate to release, you know, and what's not? And, you know, pretty much all of the time when an investor says, hey, can you send me your financials? That's okay. If they start asking for things like customer names and your with the signed revenue, that's super edge case, and probably wouldn't want to do that, because maybe they're kicking the tires on you know, for one of their current portfolio companies or another investment they're thinking about, right? But I do think it's awesome just to have a very simple, lightweight data room set up. Just makes it super easy to get and automate a lot of that process. One of the things, sorry, go ahead.
Before we jump onto something else, I think you touched on something that's really important, Mike, that is, I think, not talked about enough. When you go out and share stuff about your company, this is why it's so important to do your research, because if it is, and look, I'm not saying that investors do this, it's possible. It's not appreciated in the market because people will know about it, but there have been instances where investors will take a call, look at your stuff in order to support one of their existing portfolio companies. And so whenever you do your research and you see that there may be a competitor, or there is a literal competitor in their portfolio, I would be very careful about the information that you share, and ask yourself, is this the right investor for me? And if so, what the differentiators are, because there is a conflict of interest that can happen there. And you wouldn't want for some of your very hard work to be, you know, copied and pasted somewhere else. And again, it doesn't happen as often, but that's why the relationship part is even more important. You really have to do your due diligence on the investor as well. Like, investors, you need to due diligence us and see, are you the person I want to marry in this investment? And if the answer is no, because I'm afraid you're going to, you know, do something with my assets, probably you shouldn't take money from them.
Yeah, I write a weekly note to all of the founders and CEOs in our community. Last week I wrote one, or 2 weeks ago we asked, how likely are you to recommend your current lead investor to other founders? Just a simple NPS score. And the results were pretty staggering. It was like a 26, which is good, not great. It's like airline. Well, airlines are pretty bad, but the theme is like, I was like, it's a lot easier to change your preferred airline than like your cap table and the people you do business with. So that relationship's super important, and digging in and doing diligence on those investors. You know, call other founders, talk to people, back channel those investors. I think great investors will also be very candid and say like, hey, you should talk to any of my companies in my portfolio. That's a good sign. I think one of the other last quick tip that I heard this from someone else, you know, as you're going through that fundraising process and building relationships with investors, simply ask them to do a couple things for you, right? Like, hey, I would love intros to these types of people, or these, you know, 2 things. and you'll quickly see like how engaged they are with your business and likely to help. And that's also a great leading indicator for what that relationship would look like.
Mm-hmm. Yeah,
Related
that's
sorry,
a great point. Oh no, go ahead.
I wanted to cover this real quick because we have a lot of questions, and I want to make sure we're going to wrap up here on time. This is something we've been working on at Visible now behind the scenes since November. We actually started at our offsite, and it's a narrative table we're going to make available to everyone today. It's about 10,000 different investors, and oops, let me go back here. We're crowdsourcing this data because a ton of people put amazing lists out there. You know, top seed SaaS investors or e-commerce investors. And so we've hired someone full time to basically take all of those in and dedupe all of the records and bring everything into one place. So things like stages, your thesis, check sizes, you know, where they will or not invest, will they take a board seat, will they lead around? So these are all data points we're actively capturing. This will be tied into our CRM. So we're gonna make this free to everyone. We'll send it out after. We're calling it Connect, but it's not a list of like, here's all the people that go spam, right? It's who should I think about that's right for my business at this given point? And then who do I need to build a relationship with? And so that's the goal of this project. We're super excited by it. It's been a project that's been in the works for a while, and we've been slowly getting access, and we'll be taking it live to the world pretty soon here. So we're gonna make sure everyone gets a first sneak peek at this with a write up after.
That is so cool, Mike. You left this in your back pocket. I love it. I can't wait to check it out because I mean, honestly, I think oftentimes founders have a really hard time on finding this data. So, you know, investors will be like, beat thesis aligned. And then you know, founders are like, what does that even mean? Because sometimes investors are really vague. So having this kind of data is really critical and important. I can't wait to jump into it.
Yeah, it's something we, like I said, we're spending money on it. It's a thing for us. And like, why does this not exist? And usually it's because this is something you do once. You know, it's like you fundraise at this for your given stage once. And so there's not a huge effort by anyone to pull all this together and make it available to founders and entrepreneurs because, you know, once I fundraise my pre-seed round, I'm never going to do that again, or hopefully I never have to do that again unless I start my next company. And then I go but see my seed round, right? And so all of those investors change and everything's just changing, and there's been no central effort. And we're trying to lead the charge on that, and we're working with a lot of different partners, which has been fun. So we'll make that live to everyone. Really excited by it. We talked a little bit about, actually we talked about pretty much all of this, building relationships. So we covered a lot of that in our previous. Really quick, I just want to talk, we talked about the data room a little bit and fundraising strategy and all that. I think momentum is just crucial in a fundraising strategy, right? Because ultimately, the way you get a deal done is hopefully if it's competitive. And if it's competitive, you know, you have to have a process and momentum. First Round Capital put this awesome article together around thinking of fundraising like surfing sets and how you build cohorts of investors and move them through a process. You know, I think and a lot of this was maybe related to seed type investing, but maybe taking a step behind that seed or, you know, pre-seed. For what are your favorite fundraising tactics or strategies that you like to give a lot of the founders you work with, Lolita? Is it, you know, treating it as a process and full-time job, and you know, setting, you know, a month or 2 months for this time-intensive thing? How do you think about a great process, call it for a pre-seed company to fundraise?
Yeah, so I wish I could say time box it and then neatly package it and move on. Realities are that oftentimes you're always fundraising, whether it's because you're preparing for the official one or not, right? Because we're talking about build relationships, and that's kind of part of the fundraising process. And so in a way, you're building up. And so I would say if you're a founder raising money, you're always a salesperson for your company on two ways, one to your customers, one to investors. And so having that mindset, I think, is really important. You're always selling, always be selling. And in that note, you know, Mike, you and I talked about it in another call where we were talking about fundraising, like being a sales process, a traditional sales process. And so my biggest pointer here is use a sheet, a Google sheet, an Airtable, or a CRM platform, whatever you can access, and catalog what you're doing, right? There are stages that you want to take investors through, where it's maybe primary conversation, you get some sort of interest, you are talking terms, you sign a term sheet, you get your money. So there's definitely stages that you can set. And literally, you know, that's one view of the data, but then you have a list of your targets. And you're tracking everything, and hopefully also keeping notes, because you'll talk to so many, you're gonna often probably face rejection. Like maybe 1 out of 10 will say yes. I don't know. The ratio of conversion is wide and deep for everybody. It's different. But keeping notes and reflecting back on your process and what you've learned, so you can adjust your sales pitch, right? Which is what it is really important. So whether it's a CRM because you can pay for it, or, you know, HubSpot has a free one as well. I personally use it to track my investments. Having a stage flow, your targets, your notes, and updating it is really important, so you can keep on top of everything, because you will have to talk to probably hundreds of investors. And in terms of time frame, I think only you know how much time you can devote to it. But I'd say that if I were to give you like, devote 2 months and then you're done, I don't think that's reality, especially now.
Yeah, I think, I guess the one thing I will say, at least from talking to our customer base, is it takes a lot longer than you think it does. So if you think it's going to take you 2 months, multiply that by 3. It's like a rule of 3. So I think people are always shocked at how long that process takes. The Y Combinator article I mentioned, their data set suggested, at least for companies raising a Series A, so it's a little bit later down the pipe, but 30 coffee meetings results in like 15 partner or pitches with a single partner. Then there's some percentage that gets to the partnership, and then 1 term sheet, right? So that's for 30 top of funnel all the way down to 1. That's 1 term sheet, right? You likely want to understand what the value is of your company, and you want multiple term sheets if possible. So
I'm so excited. I'm excited for the follow-up, because you're dropping all these awesome resource references. So I'm excited to dive into it. I hadn't heard of that one, but yeah, it takes a long time. It's just like if you thought it was going to cost you that, it's probably going to cost you 3 times what you think. So it's same application.
Our engineering team likes to say, at least, and it's like product, when you're building product and the engineer says it's going to take a month, multiply it by 3. So I think that's
be conservative. Be conservative in your amount of time you're going to spend when you're planning for that. Yeah.
One last thing, and then we can wrap up with a couple of questions. Lolita, I know you're really big in helping underrepresented founders and some of the work at Backstage. You have an amazing Airtable. We'll make sure to link as well in the follow-up, and we'll put it here in the chat. Any parting thoughts around how to help underrepresented founders, people that have traditionally not have been able to attract venture capital? Anything you want to touch on there?
Yeah, I think first of all, just knowing that you are not invisible to me and to many of us in the ecosystem who are fighting the fight to make sure that we have more money going to underestimated founders, and also to increase the number of underestimated investors, frankly, because we need both sides of the coin. So, but it is a big issue. It's really hard. Pattern matching is real, and there's going to be a lot of people who don't value you, who underestimate you, who overlook you. But don't let that, take you down. Feel your feelings, because it sucks. It sucks. But know that there are folks that are out here, and organizations and funds that believe in you. And I certainly believe in our ecosystem. And my personal mission in life is to support a world that where technology is created and led by the diversity of our population. And I want to support that, because it's only when that happens that everyone's going to really take advantage of the products and services that the world offers, and it actually will apply to you and the many, as opposed to just the elite few. So that's one thing I would say. The other thing I would say is, because there are specific organizations and initiatives that are set for people of color, LGBTQ, women, and other minorities, seek those out and take advantage of them. Take advantage of them. there's a few resources that I also have. And I created, for example, a Black female founder resource guide. And it's just, the stuff is out there. It's not as plentiful as we would like, but it is growing, and we're going in a direction of an ecosystem where I know some investors are all in, some are just PR, and you have to differentiate between the people who are just saying it for marketing and the people who are really in it for what it is. Again, that's why research and developing relationships is so important. And then there are specific, Christy from Backstage Capital actually put together a list of existing funds that are actively investing in people of color or founders of color. And so look for these things. They're not centralized, but they are out there. So Google, tweet, search, whatever you need, but the resources are out there. And in fact, I'll tell you one more thing, because I just this week partnered with Arlen Hamilton. She has a new course on fundraising from scratch. And I've partnered because I was building my own course for first-time founders, and I'm like, oh, she's already doing it, so let's just bring it together. And Arlen's a really good friend of mine, and she's talk about people that I trust. She's amazing, and the course itself is built for all of us, for the people who are different, right? And because different doesn't mean that we shouldn't shine. And look, we need our support system, and all I have to say is the resources are coming. And we are here, and we want to see you rise and shine. But you will have to do extra work. Unfortunately, we all have to. It's kind of the badge of honor that we wear, which is also part of what I think is the strength of underestimated founders, which is we have to be scrappy, we have to be gritty, we have to work that much harder. And so I personally believe that makes us stronger. We just need to see that. And it will mean that a lot of things suck, but we have it in us. And I just think it's really important to remember that, and remember that there is an ecosystem that is building to support all of us.
Well said. I'm like ready to go run through a brick wall right now. Feel jazzed. That was awesome. Well, we have 2 minutes left. This has been absolutely phenomenal. There's a couple questions I would love to get to, Lolita. Do you have 2 more minutes?
Sure, absolutely.
All right. And for anyone that has a more specific question, we do a pretty good job of curating those and getting back through email. So we'll make sure to do that. But a couple ones that I hear all the time as well, and would love just to pick your brain while we have it for 2 more minutes. Well, people have been writing in around equity among co-founders. How do you go about splitting it? Like what? And again, I'm sure it depends, and there's a lot, but any do's or don'ts immediately you can think of like how to go about splitting equity among co-founders?
Yeah, sure. And also, by the way, I will answer the question, but if you would like to just DM me on Twitter with your questions, I'm happy to also answer them. It may take me a little bit, but I will get to them. On the question on equity splits between founders, I've read a lot of different perspectives on it. A 50-50 split seems to be what people initially think is a good idea. It often becomes a very challenging thing. It's a very subjective answer that I'll give you, honestly. I don't think there's a right or wrong. There's just what happens and what I think. I personally would go with 50-50 if you 100%. Again, are you marrying this person and you want them to have equal authority? Just think about it that way, right? Are you comfortable with that? Or if it was your initial idea and then you brought someone in to be your co-founder, maybe it's a different split, right? You need to think about it in terms of what kind of behavior will the split of equity drive in terms of relationship and behavior, and have a little bit of a mid and longer term view in terms of the implications of how you set that equity dynamic. And it's really, it seems like an easy thing to think about, but there's actually lots of factors to think about, because depending on what you decide then can make it very difficult to make decisions in terms of where you want to pivot the company. If you're 50-50, if you have the same amount of equity, I should say, and you want to pivot this way and the other person wants to pivot that way, it becomes a lot harder than if you initially said, well, I started this, I brought you in, and so let's split it in this particular way, and now it means that I have veto power, right? So it's a complex answer.
Yeah. That is awesome. We have a couple questions that we will certainly get back to everyone through Twitter or email. I just want to make sure we're respectful of everyone's time here. This has been absolutely phenomenal. Lolita, thank you so much for your time. Couple of quick teasers. Visible, we are doing 2 more webinars coming up here in May and early June. One is with Elizabeth Yin, a great founder, a friend of Lolita. She was actually our first one that we started this whole series with back in 2019. She's coming back. It's going to be awesome. She's a general partner at Hustle Fund. Check her out on Twitter. She does an awesome tweet storm about ads and how ads work. So she's going to be joining us. And Scott Dorsey is going to be joining us as well. Scott is the founder of Exacttarget. He started the company in 2002, I believe, took it public, and then ended up selling it to Salesforce for $2.5 billion. He's one of the investors here at Visible, and an amazing leader and communicator. We're going to be covering leadership and how do you lead in a time of crisis. He's done it twice through the original bust of 2000 and then the 08 financial crisis. So he's going to be on with us as well. Super excited for those webinars. Lolita, thank you so much for your time. And
thank you.
Everyone streaming in saying how much they loved it. So appreciate it. And we'll talk to everyone soon.
Thanks, everyone. Take care. Good luck.
See you guys.